Hello, and thanks for joining me. I am Rebecca Wallenfelsz. I'm a partner in the Trust and Estates Department at Chapman and Cutler. My focus in the Trust and Estates Group is on estate planning, looking in particular at federal and state estate or inheritance taxes for my clients and helping them reduce those tax liabilities. Joining me today is Mike Jankowske. Mike is president of the Hamelind Group, which provides plan giving resources and strategies to professional advisors like myself, to donors, and to non-for-profits. But prior to starting Hamlin, Mike was a financial planner who has been helping his clients for the last 30 years rethink their assets and their investments through a tax lens, which really speaks to me. And he's looking at it through both an income tax lens as well as that estate and inheritance tax lens. And what Mike wants to do is have clients think through their assets and their investments through tax diversification. So, Mike, would you tell us, please, what is tax diversification? What do you mean when you say that?
Well, I think it would be important to explain why tax diversification has become very important. It has to do with the evolution of taxes in this country. So what I can tell you is we've evolved or devolved in federal income tax rates all the way down from 90% to 70 to 50 to I think the top tax bracket's 37% before you start whacking extra charges. So the bottom line is everybody thinks, well, we're okay. We're not paying a high tax rate. But during that same time period, what evolved was the evolution of consumption tax, which means imagine you being able to uh, suddenly find that every time you do something like drive your car, go to a hotel, fly in an airline, sales tax, you name it, there's been an avalanche of consumption tax, which has filled the gap that we paid and perhaps even exceeded the amount of tax we pay back at the higher income tax levels. So with that being said, in many groups seminars I've done, I've walked people through the exercise of looking at all the taxes they would pay. They all start to want to start a revolution with their government to see what they do to stop the hemorrhaging in terms of what they pay in taxes. So what I've always come out with is where can we have the ability to reduce what we pay in overall taxes? You're not going to consume less, but you're likely to turn around and possibly reduce your income taxes from the federal government and your state income taxes. And along with that, with that has evolved a concept called tax diversification. I'm not the original author of the tax diversification. Over the years, I've been working with clients and, in fact, other professionals. I've basically refined the concept beyond that. But what tax diversification does, it takes a look at your wealth, not just your actual investments like in portfolios, and allocates them to what we call tax categories. And to give you a better understanding of what the income tax consequences are going to be when you want to use the money inside of those different tax categories. So I'll do a quick definition of the tax categories to give you an idea what we're talking about. This is somewhat technical, but Rebecca will stop me if I get too technical. All right. So the first category is tax qualified tax deferred investments. And what that is things like your traditional 401k plan, IRA, tax sheltered annuity, which is 403b plan, where when you put money into that kind of vehicle in that category, you get a tax break in the beginning. You tax defer, or as I put it, you tax postpone the taxes. So at some future date, 100% of what you take out of there will end up being taxable. Stay tuned for that nightmare as we go into this more. The next category is non-qualified tax deferred investments. And that is something where you put money after you've already paid taxes, you put it into vehicles such as what we call non-qualified annuities, savings bonds that are tax deferred, life insurance if not structurally created for the client, where you postpone, you kick the can down the road on what you get in growth in that category, but you end up paying income taxes. And again, you're postponing the inevitable. It's not like it's bad to have it there, but that's what the category is. The third category is the one everybody wants to be in. Notice I say everybody, including Rebecca. And that's the tax exempt category. Now,
Okay.
that sounds funny when I say that, but what that means is you take money you've already paid taxes on and you put it into certain types of category items in that bucket where you pay taxes on it, and any growth from that particular holding grows totally income tax free with some exceptions, both from the federal and the state level. Examples of what's in the tax exempt category are Roth IRAs. Another example would be tax exempt muni bonds or muni bond funds. Another one would be if you structure life insurance properly, you can make it behave like a tax exempt vehicle, all inside of that particular category. As I've said before, most people say, I want all my money there. Well, that may not be likely, okay? But it would certainly help if you had more money there, because that would reduce your overall taxes in the big picture. The next category, what we call taxable investments. Taxable investments are like the hodgepodge of, excuse me, you have a traditional investment portfolio which throws off interest or dividends or capital gains. You have a business interest or multiple business interests. You have real estate, whether it's individually owned or commercial, where the theme of that is you kind of like pay as you go in terms of paying some sort of tax every year. And then you kick the can down the road and suddenly you are facing immense capital gain issues further down the road because you're postponing the inevitable again. All right. So that's that particular category. And again, one thing I could comment on here is traditionally, if you're lower wealth levels, most people park their money in the tax qualified, tax deferred arena, that 401k plan, that IRA. They have less money in the taxable. But as you ratchet up wealth levels in this country, the taxable category becomes much bigger than the tax qualified category. It basically compounds the problem when you have enough, too much in both those categories. Anyway, the next tax category is kind of like a misnomer. It's called tax shelters. And what that means is it's not necessarily an investment you make in this category or allocate. There's ways that you can counteract the taxes if you're trying to reallocate positions in each tax category to be more favorable from an income tax perspective moving forward. Okay, stay tuned for more of those interesting strategies, which will get to my passion and Rebecca's passion at the same time. But it would be a misnomer not to mention category number 6, Rebecca's favorite category.
Second favorite.
What?
Tax exempts first. This is the second.
I'm sorry. Did I misspoke? You know, we've done these videos before, and I can tell you that before it was all about trusts, which is the 4th category. But now that she's had some religion about wanting to be tax-free everywhere, trusts are another category. And I'm not referring to revocable living trusts or irrevocable trusts you can create. And you can play a game with irrevocable trusts to deflect income tax liability to somebody in the lower tax bracket, et cetera, et cetera. Suffice to say that gives you the ability to retain or distribute money and have somebody else pay the tax, the trust pays the taxes. So that's another category. It's relevant, especially when you could use some of the trusts in that category as part of the strategy in the bucket I just mentioned before to counteract the taxes. So those are the 4 categories. And typically speaking, when I've worked with clients in the past, and even now with charities, okay, and professional advisors, we look at where somebody's positioned right now by putting in the dollar value of their wealth in each one of these tax categories. And the first thing that people will say is, well, I don't know what this means, but it seems like I'm out of balance. And I don't have enough in tax exempt. I don't have enough in tax exempt, right, Rebecca? So now comes the discussion, because typically people who look at income taxes think in 12-month increments. Even CPAs, for example, God bless them, only have software that analyzes up to 5 years to 10 years of what would happen with not much wiggle room to change things from a planning perspective. So here's the key. Once you know that you're kind of not diversified, what does that mean to you income tax wise in terms of understanding what your tax liability would be right now, 5 years down the road, 10 years down the road for the rest of your life? and then compare that to what you do if you transition or move wealth among different tax categories, and specifically to Rebecca's favorite category, the tax exempt category. What would be the impact? Now, there may be a cost associated with that, but the cost is minuscule in comparison to the overall tax savings you do by being more diversified from the tax perspective.
Yeah. And importantly, too, in understanding these tax diversification, especially like that first bucket you mentioned, the tax qualified, tax deferred, like people so like that bucket when I'm contributing, right, to retirement plans because I'm not paying taxes now. I'm, not paying taxes while this asset grows, but you have to pay taxes, at the back end. And the problem with that bucket is you often don't have control over how much and when things have to come out of that bucket because let me trust me, there's tax rules that require you to take out money from that bucket. If you can't control that dollar amount, you've lost control over managing your income tax liability.
I'm glad you brought that up because typically when I've done work with folks looking at this concept, there's a way that my planning tool software actually analyzes, and you can export it to an Excel spreadsheet, how much tax liability you're going to have based upon the path you're taking.
Yep.
And when they see that number, they kind of pass out, especially post-retirement, because most people perceive that once they retire, they're going to pay less taxes. And not so. But the bottom line is, once somebody understands what their baseline is and what they would be paying in lifetime income taxes, now that opens the door for people to be more proactive and think beyond 12-month increments in terms of what they can do. Mm-hmm. That's the key here. We're hopefully going to be in other videos delving deeper into these categories and understanding the opportunities and obviously nightmares that get created by having too much in one category.
Yeah. And so rounding back out this discussion, before we wrap up this video, in moving items from one bucket to another bucket, this is where someone who's got an interest in charitable giving and charitable planning can make use of that interest and that passion to really, I think, leverage what they give to charity and, importantly, move money into a more favorable tax bucket.
Yeah, there's a concept that the society has taken a different definition of. I won't use the concept, but suffice to say, proper tax diversification will utilize charitable giving tool arrangements, which in effect take, if you take a look at what you save in income taxes as part of the tax diversification that you would have paid to the feds, for example, the part of what you're going to save in taxes goes into a charitable bucket that you can use to give back, where you can provide money to the social good. So in reality, everybody wins. But this is the part where people don't understand that, because everybody talks about the term, which I hate, called charitable intent. Well, if you suddenly found out you'd have more money available for you and your family that are more tax favored, and according to Rebecca, in all the tax exempt category, you suddenly have this big bucket of money sitting there you can give back to the charities you personally want to support, and the government says it's okay. Why wouldn't you investigate it?
Right. Yeah, right. And that's where, I think when people understand that they are better off, their family is better off, and they have some money set aside for charity versus if they did not engage in this examination of tax diversification at all.
Yeah, and again, most people say, is that possible? There's skepticism without question. But yeah, the only way you're going to find out is if you take a look at your own financial situation and take a look at tax diversification strategies. And then what will happen is suddenly the light bulb goes on and suddenly they realize what it is they haven't been advised on in the past. I do believe that in all professional advisors, whether attorneys, CPAs, or financial advisors, et cetera, really don't have the resource tools or the education and the experience in knowing how to identify opportunities in tax diversification. We're hopeful this would be great for anybody that would see this video to say, oh, I need to find out more. And we're going to give you more. So
that's right. This is going to be the first in a series where we talk and dive a little bit deeper into these tax categories and talk about ways and strategies you can move money from one bucket to another bucket, and how you can offset some of that tax liability that may happen. when you move money from a taxable bucket to a tax exempt bucket. So thank you, Mike, for joining me today.
It was a pleasure, Rebecca. Remember, we're going to get you all in tax exempt, right?
Yes.
Okay. All right. Take care, everybody.